You know, Restaurant Brands International, or RBI, just dropped some fantastic-looking numbers. And this is the interesting part, those headline figures hide a really fascinating puzzle. So let's get behind the numbers and see what's really going on inside this fast food giant.
So who is RBI? Well, they're the global powerhouse behind some brands you definitely know. We're talking Burger King, the beloved Canadian coffee and donut chain Tim Hortons, the legendary Popeyes, and the super fast-growing Firehouse Subs, a real heavy hitter.
And on the surface, everything looked awesome. RBI beat Wall Street's expectations on both profit and revenue. But when you start to dig just a little bit deeper, a much more complicated story starts to emerge. It's really a tale of huge successes running right alongside some pretty serious challenges.
I mean, their performance was incredibly strong. They hit their targets, grew their earnings in a big way, and showed the kind of consistency that's just really tough to pull off in the fast food world. And this wasn't just a one-off good quarter. This is a pattern of solid growth. So the big question is, where is all this strength actually coming from?
Well, it really boils down to two key parts of the business that are just absolutely crushing it right now.
And that strength? It comes from two real powerhouses. First up, their international business is on fire. Sales growth in the double digits. And that's not just from opening new stores. Their existing restaurants are absolutely booming. And second, back in Canada, Tim Hortons is just an incredibly reliable engine. It has now posted 19 straight quarters of growth. That's nearly 5 years of nonstop growth, consistently beating the competition.
And just to be clear, this isn't about opening a few restaurants here and there. No way. RBI has built multiple individual billion-dollar markets for Burger King all around the world. I mean, think about that. In France alone, it's a $2 billion business. This global machine is a massive, massive competitive advantage for them.
But that brings us to our second point. Because while the international business is absolutely soaring, the story for Burger King in its home market, the US, is, well, it's a lot more complicated. In fact, it's a real head-scratcher.
And this right here is the central puzzle. Burger King's marketing is working. Promotions like the SpongeBob one are getting people in the door. Sales are going up. They're even outperforming their competitors. So how on earth are the people who actually own and operate the restaurants, the franchisees, making less money?
This chart just lays out the problem in stark terms. The average Burger King franchisee in the U.S. saw their profits drop from about $205,000 in 2024 down to $185,000 in 2025. You just can't have a healthy system if your operators are seeing their profits shrink like this. So what in the world is going on?
Well, here's the villain of the story. Beef. The cost of beef, which is Burger King's single biggest expense, skyrocketed by over 20% in just 1 year. That massive inflationary pressure completely wiped out the gains they were making on the sales side and just squeezed those franchisee profits hard.
And here's why this is so crucial. It's not just about one bad year. When franchisees make less money, they have less cash to invest back into the business. That means they can't afford to do the critical remodels, which is a key part of Burger King's Reclaim the Flame turnaround plan. It creates a major headwind for future growth. But Burger King isn't the only U.S. brand with challenges. If Burger King has a profitability problem, Popeyes seems to have a bit of an everything problem. The brand that was the talk of the entire industry just a few years ago has hit a major wall.
I mean, just look at the scorecard here. Comparable sales went from slightly positive to nearly 3% negative. And just like a Burger King, franchisee profits took a hit, falling by about $20,000 per restaurant. Management was very, very clear on their earnings call. This performance is not where it needs to be.
The good news is they have a plan. It's a pretty clear three-step approach. First, new leadership with a huge focus on operations. Second, more hands-on support, boosting their in-restaurant coaching teams by 75%. And third, getting back to basics, focusing the menu on the core items that made Popeyes famous in the first place.
So that brings us to the big picture. You've got huge international growth, a steady ship at Tim Hortons, but real challenges at Burger King and Popeyes in the US. So what does the road ahead actually look like for them?
Despite all these issues, management is projecting a lot of confidence. They're promising investors a fourth straight year of their target 8% growth in adjusted operating income. To put it simply, they believe they can keep that profit engine growing at a steady, reliable pace. It's a bold promise, for sure, given the headwinds.
And that leaves us with the big question for the coming year. It's really a tug of war happening inside one company. Can the incredible strength of the international business and the sheer reliability of Tim Hortons continue to pull the entire company forward, all while they wrestle with sky-high beef prices at Burger King and try to engineer a really complex turnaround at Popeyes? The answer to that question will tell the real story of RBI in 2026.